Hello, everyone. Welcome to weekly lecture videos once again. This is the last video this week. And in this video, I'm going to discuss the agency problem. We have seen in previous videos that the financial manager in a corporation acts in the best interest of the shareholders by taking actions that increase the value of firm shares. However, we have also seen that in large corporations, ownership can be spread over a large number of shareholders. And this dispersion of ownership arguably means that management effectively control the firm. Okay, so in this case, will management necessarily act in the best interest of shareholders? Put another way, might not management pursue its own goals at the shareholders' expense? So we briefly discuss these arguments in this video. First of all, agency relationship. The relationship between shareholders and management is called agency relationship. Such relationship exists whenever someone, the principal, for example, hires another, the agent, to represent his or her interests. For example, if you hire someone to sell your house when you are transferred interested by your employer. In this relation, there is a possibility that a conflict of interest may arise. And this conflict of interest between the principal and agent is called agency problem. Take the example that when you are hiring an agent to sell your house and you agree to pay a flat fee upon sale. Now, the agent's incentive in this case is to make the sale, not necessarily to get you the best price. If you paid a commission of, say, 2% of the sale price instead of a flat fee, then the agent has an incentive to sell your house at a higher price. So this example illustrates how the way an agent is compensated can affect agency problems. Okay. Now, to see how management and shareholders' interests might differ, imagine that a corporation is considering a new investment. The new investment is expected to affect the share price favorably, but it is also a relatively risky venture. The owners of the firm will wish to make the investment because that will increase the share price, but management may not want to do so because there is the possibility that things will turn out badly and management jobs will be lost. Okay, and if management does not take the investment, then the shareholders may lose a valuable opportunity. This is an example of agency cost. Now, if we go back to our question that do managers act in the shareholders' interests? So whether manager will, in fact, act in the best interest of shareholders depends on two issues. First, how closely are management goals aligned with shareholders' goals? This question relates to the way managers are compensated. Second, can management be replaced if they do not pursue shareholders' goal? This issue relates to the control of the firm. Okay, so as we will discuss, there are a number of reasons to think that even in the largest firms, management has a significant incentive to act in the interest of shareholders. First of all, managerial compensation. Management will frequently have a significant economic incentive to increase share value for two reasons. First, managerial compensation, particularly at the top, is usually tied to financial performance in general and often to share value in particular. Okay. For example, managers are frequently given the option to buy shares at a fixed price. The higher the value of the share, the more valuable this option is to them. The second incentive managers have relates to job prospects. Better performers within the firm will tend to get promoted. So more generally, those managers who are successful in pursuing shareholders' goal will be greater in demand in the labor market and thus command higher salaries. Okay. So in fact, managers who are successful in pursuing shareholders' goal can reap enormous rewards. Then corporate control. Control of the firm ultimately rests with shareholders. They elect the board of directors, which in turn hires and fires management. The mechanism by which unhappy shareholders can act to replace existing management is called proxy fight. A proxy is the authority to vote on behalf of another shareholders. A proxy fight develops when a group solicits proxies in order to replace the existing board and thereby replace existing management. Another way that management can be replaced is by takeover. Firms that are poorly managed are more attractive as acquisitions than well-managed firms because a greater profit potential exists. Thus, avoiding a takeover by another firm gives management another incentive to act in shareholders' interests. Information on executive compensation, together with plenty of other information, can be easily found out on the internet for almost all public companies, so you can have a look at them. The last point is other stakeholders. Our discussion thus far implies that management and shareholders are the only parties with an interest in the firm's decisions. This is an oversimplification, of course. Employees, customers, suppliers, or even government all have a financial interest in the firm. So these various groups are called stakeholders in the firm. In general, a stakeholder is someone other than a shareholder or creditor who potentially have a claim on cash flows of the firm. Such groups will also attempt to exert control over firm, perhaps to the detriment of the owners. Okay, before I finish my discussion on this chapter, just a couple of very quick points. Financial market and corporations. So this graph here, you can see, shows an interplay between the corporation and financial market. Okay, so the arrow traces the passage of cash flow from financial markets to the firm and from the firm back to financial market. Okay, so you can see that first of all, the firm issues securities. Okay, so in this case, the cash flow will channel from financial market to the firm. Okay, and then firm invest this cash flow in their assets and they generate cash flows. Okay, then when this cash flow is generated, they can go back to the financial market in the form of dividend, in the form of interest. They can reinvest this cash flow in the firm's asset, and some of them will also go to the government, for example, as taxes. Okay. Financial markets also function as primary and secondary markets for both debt and equity securities. The term primary market refers to the original sale of securities by government and corporations. On the other hand, the secondary market are those in which these securities are bought and sold, okay, after the original sale. Equity securities are issued by corporations. Debt securities are issued by both government and corporations. With regard to the secondary market, there are two kinds of secondary market. One is dealer market, another is auction market. Dealer buys and sell for themselves at their own risk, and they carry an inventory of item they buy and sell. Okay, a car dealer, for example, buys and sell automobiles. In contrast, brokers and agents match buyers and sellers, but they do not actually own the commodity that is being traded. Okay, a real estate agent, for example, does not normally buy and sell houses, rather brings buyers and sellers together and charges a fee for performing service. Okay. So dealer markets are generally referred to as over-the-counter markets. Most trading in debt securities take place over the counter. However, some debt securities are traded on exchanges too. Okay. Today in Australia, most shares are traded in Australian Securities Exchange, which is ASX. In New Zealand, this is New Zealand Stock Exchange, New Zealand Exchange. Both are auction market, okay, which differ from dealer markets in two ways. First, an auction market or exchange has a physical location. And second, in a dealer market, the dealer makes a profit on the difference between the buy and sell price. In the auction market, the broker brings buyers and sellers together and charges a fee for the service. The primary purpose of the auction market is to match those who wish to sell with those who wish to buy. Now, trading in corporate securities, the equity shares of all large firms in Australia and New Zealand trade on organized auction markets. So as I already mentioned, the ASX. There are many large and important financial markets outside Australia. For example, New York Stock Exchange, Tokyo Stock Exchange, London Stock Exchange. Right? The shares that trade on an organized exchange are said to be listed on that exchange. So in order to be listed, firms must meet certain minimum criteria concerning, for example, asset size and number of shareholders. These criteria differ for different exchanges. For example, to be listed on the ASX, a company is required to have a market value for its publicly held shares of at least $10 million and total of at least 400 shareholders, which each hold a parcel of shares with a minimum value of $2,000. Okay, so there are additional requirements set by each exchanges relating to such things as a minimum level of earnings, assets, and a minimum number of shares outstanding. Okay, so this is the end of our discussion on the learning objective 4, and that's also the last video this week. Okay, so if you have any questions or any problem after watching these videos, don't hesitate to send me a quick email. So thank you very much.